It's time for the second part of the show. As said, we're going to dig deep into a new financial instrument that will help in funneling institutional investor funding into the growth of emerging ecosystems. And well, you heard from Peter already, but he is a triple professor at the University of Michigan, both at the business school and in engineering. On top of that, he runs two of his own businesses. One is the Keystone Compact Group, and the other one is Equarius, right? Providing risk assessment services for large companies exposed to water risks. And he was our man with the connections to the world of finance that then allowed us to really develop this instrument that you will hear so much more about now from Peter. Peter, please take the stage.
All right, thank you so much. I was the lucky recipient of the FIDI Pro, I guess, after Antti and I accidentally met at Stanford University in the Sheraton Palo Alto. And we started chatting about things we had in common. Actually, I think we even had a breakfast there. I was there on behalf of the National Science Foundation of the University of Michigan. And I was looking at the entrepreneurial ecosystem at Stanford and Berkeley. Not to you, you would say. Looking at the entrepreneurial ecosystem at Stanford and Berkeley. Don't they know everything about entrepreneurial ecosystems? A lot of it is Brownian motion, right? You need to have productive interactions, I guess, between the investors and the entrepreneurs. And so there's still, there's a lot of work to be done still even there, still in Silicon Valley. But anyhow, so we met at the Palo Alto Sheraton and started talking about things that could be this kind of project. And, you know, he said, well, I think we may have found an investment vehicle or a funding vehicle to start working together. There's just one catch. And the one catch is you have to spend 12 months in Finland. I said, wow, that's going to be some discussion with my wife and family. So we were able to stretch it over 2.5 years, and it's been absolutely a wonderful collaboration with a lot of support from my family, who I very profusely acknowledge and thank in the introduction or in the acknowledgements of the book as well. But it's been an awesome and fascinating program and very highly nonlinear. So I'm a professor of finance, entrepreneurship, and engineering. I'm first an engineer. So I bring a lot of the statistics, probability, technical capability into the financial world, where a lot of it is about storytelling. Finance is a lot about storytelling. In the end, you have to execute. In the end, there is, of course, if you don't make a profit, if you don't make returns, it doesn't work. But it starts with a story. And I'm going to tell you a story. So I'm not going to give you any equations. We're not going to do any statistics and probability. But I'm going to tell you the story of the multi-asset fund. And the start of that, I just met my friend Esa from UPM, started with an UPM product. So this is the original napkin that Chris and Nina and I drew on in a pub in Dublin. That's always a good story, right? You go to an Irish pub and you come up with a great idea. The question is whether it's still a great idea the next day. So we had a meeting of the Global Clean Tech Cluster Association there with our, I think it was the European Gateway in Dublin, that happened to coincide with the Council of EU Environment Ministers. And basically, we were talking essentially about what the Global Clean Tech Cluster Association was, what these clusters looked like, what type of companies were members of these clusters, how these clusters were managed, how they were financed. Was it government finance? Was it private finance? Was it corporate finance? So, I mean, there are a lot of discussions out there. But before that, we were saying, well, we really have to talk a little bit about, you know, the pension funds and how we're going to be doing this, you know, making local global. And we started drawing this thing. in the bar. And as each of us had, the pen and start scribbling on this napkin, and we said, well, you've seen this map from Chris, right? So this is sort of the Global Clean Tech Cluster Association, right? We have all these clusters in companies and different continents. And then I had my tool. As Chris mentioned, the Keystone Compact is a tool that does risk assessment of companies through two lenses, and I'm not going to talk about it here. There's a whole chapter dedicated to that in the book if you want to read about it. But it's really about looking at a company through two lenses. It's basically how well is a company positioned in the industry in which it seeks to innovate. And then the second question is, and then given that position, what is the investment grade of that company? So a lot of it is about the non-financial risk of companies, which both banks and equity investors and other investors will argue is a much bigger risk than the financial risk. The non-financial risk versus the financial risk. So this is a caricature, I guess, of what the tool looks like. I'm a business professor. We can't get any more complicated than putting a 2x2 together, right? So we have to have 4 squares, preferably no labeled axes on that, and then some text sort of in the square. So that's part of a caricature of the Keystone Compact. Then we said, so we have all these companies that we can analyze from all these clusters, 10,000 companies that will all show up as a different investment grade. So now we have to bundle these companies. As Chris was saying, we have to bundle them upward to, a portfolio of 250 million or 500 million. And that, a portfolio, of course, then you start thinking about portfolio theory. I start thinking about what does that portfolio look like? How does that perform? What is the return? What is the risk? And then we were saying, well, who are really the heroes in this whole story? And the heroes are the cluster managers, the economic developers. The companies are heroes too, but the clusters are the ones that try to build the whole ecosystem out. And we said, how about we do this? I mean, if companies make it from the Keystone Compact into these portfolios, and the portfolio gets invested in by a pension fund or by a sovereign wealth fund or by a wealth management division of a bank, then we will reward the cluster and say, your company made it into that portfolio that got invested. It was a great idea, but that was already after 2 beers. It really doesn't quite work that way in finance. So then we said, essentially we can profile all these different clusters. Then this thing, Chris said, you know what, how about you present it to the Council of Environment Ministers? I said, yeah, right, napkin. So I structured, and I don't have that slide, but I structured the napkin into a slide. And I plopped it up, one slide, and talked about it. And one of the people in the audience said, who is going to manage a fund like that? My response was, a fund manager. I said, oh, okay. I had no idea. I basically just blurted out a response. It sounded good to the minister on the other side. And we said, okay, all right, good. So I passed that test. But that was really the start. And so then the whole story picks up in working with Antti, writing the proposal. And in June 2013, and look how short the time was. Oops. April 13. Was it June 13? Is that about right, Antti? Yeah, when the pre-proposal went in, I believe. So we put this proposal in to Tekes, and it was not the cheapest proposal that we put in. In fact, Tekes, and I have to really still commend them on them, really took on quite a risk in funding this project. Because there was a lot of hypotheses in here. There was not a lot of sound financial theory that we're building on. It was not an academic proposal. I wanted to have an empirical project. I wanted to work with ETLA, the Research Institute of the Finnish Economy. I wanted to get access to companies a lot more than is maybe easy, than is afforded when you're in academics. I really wanted to get my finger on the pulse of the economy. I wanted to build an empirically testable framework of investing in clusters. And this is one of the pictures, and we still use this. I believe Antti co-developed this with Tommy Jakobsen, I guess, on how the current value chain models are completely optimized for cost minimization, and how what we want to do, and you've seen some of the clusters that Antti put up. that really the emerging industries are a lot more cross-industrial. They cross over between value chains. They become very complex kind of webs, food systems, if you will, for the biologists among you. Right? And very often we talk about how food systems and finance and all of that mimic each other. Biomimicry is a field of a lot of interest, including in finance. And then the question was, out of this, how can we build sustainable portfolio models? And when I was talking to people about including in finance and elsewhere, they said, what the heck? I mean, what are you going to try to do here? I mean, it doesn't work that way. You know, people typically invest in stocks or real estate or bonds or whatever it is. So what you're trying to do here is everything but the kitchen sink mixed in a single portfolio. I said, no, we have ideas. We have ideas. So we got this funded. I arrive in January. I start my 2.5 years in Finland with my first month being January. I was thinking, this is going to be a long project. It's been a fantastic project. And I've, of course, experienced all seasons over time. So one of the first things we did was stakeholder discovery. And I'm not going to talk about all the stakeholders. It would take us too long. We would talk to government stakeholders. We talk to industry stakeholders. We want to talk about the financial stakeholders. So one of the stakeholders we talked about were pension funds, obviously. And we said, so what are your issues? What is potentially your interest in investing in clean tech? What is your interest in investing in startups? How do you invest in large corps that are involved in taking risks and in renewal? And so I'm going to put a couple of stickers up here. So one of the first things we find out, and that's of course very different from somebody coming from the United States, is that they say most pension funds, or all pension funds told us, we don't really invest much in Finnish stocks. So, okay, so a lot of global equities, and a lot of that is for diversification and for other reasons. The other thing we find out is alternative assets, and we'll talk more about this. These are not the stocks and not the bonds. Alternative assets are the return drivers of the funds. They are the ones that make the fund money. And the funds, pension funds, have long-term liabilities to pay out pensioners. So basically they need to have, make enough in order to be able to do that and have enough liquidity to be able to pay out the pensioners. So what I fairly recently read is that some of the pension funds are starting to increase capital allocations to private credit in companies. They say, okay, so this is interesting. So there is interest in alternative assets, but what alternative assets, because they are alternative and because they're not liquid, so they can't trade them on a daily basis on the market, carry more risk. So one of the feedbacks we would get was, and I'll come back to this one later, we'd like to commit a lot more to alternative assets, but with the same risk as bonds. And I was sort of staring at this person and said, the market does not reward that way. It doesn't work that way. But I'll come back when we're dealing with the fund on how we try to deal with that. So you don't want to take risk, but you want to have high return. And those are very often fairly incompatible demands or desires. Investments need to be preferably long-term, right? Long-term and passive, if possible. And should not follow one pension fund basically they said, okay, this conversation is going to be over in about 10 minutes. Don't come talking to me about investing in clean tech. Clean tech is a policy fad. It's going to be over when the next elections are over. And then it's going to be something else. It has to be market-driven. If there is no underlying financial, transactional, sustainable capacity behind that, then it's not worth investing in. And these are conversations that Chris and Nina and I heard in Washington, D.C. a couple of years ago. What was it? GTDI workshop where they said, we don't care about investing in a wind turbine company. We care about investing in a company that makes high-quality turbines, some of whom might be used for wind generation. If the company in and by itself is not a financially sound, sustainable, profitable, and whatnot company, we don't care whether it's clean tech or something else. It's about the company. It's not about the policy fad. So, now this was, to us, Antti and I were looking at each other and said, what's the impact of this on our project? Another one, we found out that many pension funds admit it, and you probably know it from the media also, including in the US and elsewhere. And in Switzerland, as I was just talking to Chris about this, Finnish pension funds are at tipping points, where essentially the intake and the growth are barely sufficient to deal with the long-term liabilities. So basically, pension funds are looking to crank up returns, hence the interest in alternative assets. So we need to search for new things to invest in that generate above-market returns. Yeah. Another one. Which one did I just add? Corporate bonds, as everybody knows. Well, government bonds are not attractive. Ooh, they're negative. Corporate bonds are not very attractive either, because if you were to invest in a corporate bond, the corporate bond generally has more risk than a government bond. But if the spread in the interest between a government bond and a corporate bond isn't high enough, why take the risk? Right? Makes a lot of sense. If there is no reward for your risk, why would you do anything? Right? So, which is why, again, the shift potentially into the real economy. And the last one, infrastructure was deemed as not being very attractive, infrastructure as debt, infrastructure debt, because there is no long-term ownership or revenue structure options, I guess, after the investment is done. And that's why now we're starting to come up with infrastructure bonds, which are a very different way of dealing with it. So essentially, these are some of the lessons we learned. Global, alternative assets, real economy, market-driven, long-term, passive. Okay, Antti, let's get to work. And over time, we engaged about 20 people or so from the ETLA offices, from University of Michigan, from Aalto University, from many different places where we, and then colleagues from Jyväskylä and other universities that we engaged. So, here's some hard numbers. I mean, this is one of my few plots here. Europe lags behind in allocations to alternatives. So this is a fairly recent study that was done where we compare the allocations that pension funds make and how they make money, their investment strategies, right, to equities, I mean public stocks, bonds or other types of fixed income, alternatives, and here I list them or fall off, like hedge funds, private credit, venture capital, private equity, infrastructure, real estate, commodities. That's essentially everything that fits under this bucket over here. And what you're seeing is that Europe is half of North America. And actually within Europe, I don't have that table, but within Europe, the Nordics have even lesser allocations to alternatives. So there is an inter-European or an intra-European diversification also of allocations. So that was a challenge. If pension funds don't want to or don't have the propensity to take any kind of risk, then it's going to be difficult to structure new investment instruments that pension funds would be interested in. Right? So therefore, we kept that thing in mind where they said we want higher returns, but with risks that is similar to where most of our money sits, in fixed income. So we started out, and I'm going to show a couple of fun slides too, with, this is not a toy, despite what some of you might think. This is Lego Serious Play. Who's familiar with Lego Serious Play? Ah, some of you are. Great. So Lego Serious Play is used in corporate boardrooms to actually draw together and bring together strategic groups to start visualizing and thinking about strategy shifts, productization shifts, and whatnot. And basically, we worked with a team of 8 of all different kind of qualities in private sessions, individual builds, group builds, discussions, to visualize risk, to visualize startups, SMEs, large corporates, to visualize government support. So it was a month worth of time where we essentially try to create visually what a fund would look like. And what that does is it is a constant discussion over what are the data relationships, what are the risk relationships, what are the guarantee relationships. So there's all sorts of elements around a fund and things that sit in a fund. It's an ideation tool, right? So we talk about, so what is a fast and unstable company? How do you visualize that? So we really have to think about what sits in that bucket What sits in a fund like that, that theoretically mimics the ecosystem that Antti showed you, that ball of yarn? What all sits in there? We have large corporations, we have SMEs, we have startups, and then we have all of these across many different industry sectors. The capital structures of the companies are very different. The governance structures of these companies are very different. The stakeholders in these companies are very different. So we have to really tease this out. So this is the thing that the ultimate, and I show this at all my design workshops where I go to, it's like, look, this is essentially the portfolio investment roadmap for industrial renewal. It's like, what? It's a Lego piece. So we spent a lot of time looking at what does a value system strategist really do? How do they look at what emergence and nascent new industries are? And how do you value these new companies? What does the public equity analyst do? What is his relationship or her relationship to the institutional investor, to the VCPE investor? And so this is the overview. And actually, I think you like the description of this in the conclusions of the book. So it's actually described what these things mean. So you think, again, why is this not child's play? I put a little blog out on that. I mean, I'm a LinkedIn junkie. So anybody wants to connect with me on LinkedIn, please connect. If you don't do it, I'll do it. So I put a blog out. And within 2 weeks, we get a call from the vice president out of the vice chairman's office of Deutsche Bank in London. I said, Peter, how the heck did you guys build a portfolio using Lego? So I can't tell you that in a couple of minutes on the phone, right? But we can come out and come visit you. Because what we ended up doing is, I'll go back. We ended up building an actual structure out of that. And we wrote up a little white paper. And Antti and myself and who else was there? Alex, right? A couple of us were out there. We went out there and we talked to a person who had managed equities, who had managed private equities, and had managed hedge funds. And he was looking at this thing for an hour. He let me talk for about 3 minutes. And I said, okay. Let me take this thing. He tore it all apart and he built it back up. He never said, no, this will not work. Which was, to us, ooh. Even with Lego, we can do something that a seasoned investor who had invested in Asia, Europe, and the United States at 6 different banks in multiple different asset classes knows how to manage. So now all of these are companies. All of these are Finnish clean tech companies and some global ones. So, but one of the things that came out is like, we really have to think about this differently. We really have to structure this. We have to structure our project around the different components of the economy. We have to understand these ecosystems in order to design the fund. So we have to understand it, the stocks and the flows of the economy, and that's what Antti already showed you. We have to use an analytical tool. That's what fintech is. Fintech is all about finding efficiencies in the financial system. Yeah. Non-financial risk analytics, financial risk analytics, and then out of that comes some sort of a fund. Well, this was the thing we came up with after the Lego and after our initial play. And so we said, okay, so we have companies in our system, large public-private companies. Okay, we're going to stick those into a thematic exchange-traded fund, essentially an index of stocks. Yeah? Thematic to smart grid or thematic to green chemistry or whatnot. We have then our SMEs and startups. Well, some of those will go into private equity investments. Some of those will be leveraged credit, debt. Yeah? And then we'll have to offset some of that risk because this is not tradable stock, this is risk. Right? This is tradable, this is very liquid. So now we'll add some bonds to that. We'll add some bonds in the mix because we looked at the Finnish pension funds and European pension funds, and we know that 40% of all the allocations sit in bond type of instruments. So the overall is this multi-asset renewal fund, and we said, you know what? The investors tell us what they got is too low. We need to get net 6 to 8% back to them. Right? Which means you need to get more after you're subtracting all the costs and the management costs and everything else. And we were building in some government guarantees on the debt. The government guarantee was very specifically just for the credit. So in case a company defaults, that there is some government credit. This is the economic development piece. So this is what I just mentioned earlier. So we did that road testing, and that was very interesting. I mean, not just with HSBC, with Deutsche Bank. I already mentioned that to you. So they put a lot of constraints around the governance structure of a fund like that if we wanted to do this. And I don't want to go into detail because that's too technical. But it's basically, I mean, you have to have a lock-in that for a certain amount of time you have to park your money in that fund. Closed-end essentially means that the investor that comes in the fund has no say over where their money goes. It's the management of the fund that decides where it should be allocated, because we have to constantly allocate over these 4 asset classes. And then and then he said one of the biggest challenges is going to be the management of this fund. So we spent a fair bit of time on management. So that was at Deutsche. So from Deutsche we hopped over, since we were in London, and figured, might as well go to the next one. And so we went to HSBC. And because of a personal contact that we had, we managed to go talk to the head of global debt at HSBC. So the head of global debt was just recently in the news because of climate bonds. So basically they're looking at how does one structure climate bonds. What is the risk of climate bonds? What should be the reward of climate bonds? What should be the cost of climate bonds? So we got a lot of information from them on debt. How do we deal with debt? How do we deal with the bonds? Then I hopped over to Belgium. As a Belgian, I had some contacts at KBC in Brussels in the wealth management group, and we talked to them. And most of the questions there were, wow, this is fascinating that you essentially want to take this entire ecosystem, drop it into a fund, and get money. But the feedback I got from them was interesting, because they said, where are you going to register this? I have no idea. So maybe Switzerland, because Chris is from Switzerland. I said, no, I think you should take it to Luxembourg. I said, okay, why Luxembourg? He said, because Luxembourg is sort of within Europe, more of the seat of registration of alternative assets. And they also have a lock-in pretty much on something called the European Long-Term Investment Fund, which was approved about 2 months before I showed up at KBC. He said, have you thought about registering this as a European long-term investment fund? I said, what is a European long-term investment fund? So it had just gotten approved. They were talking about maybe we could set this up as an insurance fund. Now, I should tell you that when I was sitting and talking to them, they were teaching me a lot, because I really couldn't push back much. I didn't know anything about these funds. But again, they were not saying no. We're not saying no. MSCI ESG Research, of course, many of you know MSCI, global index provider. Actually, one of the members of our steering committee, Antti Savlaksa, so he was at MSCI. He moved from Nordea to MSCI, was the head of ESG Research. I've had long-term relationships with them. Also, the questions they asked is, if you set up a fund that has all these different assets in it around smart grid, or around smart mobility, around green chemistry, what's going to be the net impact in terms of CO2 reductions of a fund like that? So they were very interested in scaling CO2 reduction. They said, right now all we're doing is a project here, a company there, but if you have an entire fund that actually has that net impact that can be monitored or measured, I mean, you would have a major impact and interest from impact investors. So the big question was still, this is Antti's, or I guess our ball of yarn. We just had a paper structure, right? We had a paper structure that said, we need private equity, we need debt, we need stocks, we need bonds. But in reality, we were dealing with thousands of Finnish companies. So how do you go from thousands of Finnish companies to a fund that has these companies allocated in each of these asset classes? That became our big question. Right? How do you go from point A to point B? And how can you promise to a pension fund that whatever you're doing does really economic development, i.e. investment in SMEs, at enhanced market returns, which is what they want? Because the pension fund, per definition, is not necessarily interested in economic development. That's not their mission. Their mission is long-term liabilities and have enough liquidity for long-term liabilities. If we can make it work, we can make it work. We will see. So, long story short, so basically we developed over time, this is as simple as I can make the last 3 years of research. If there would be one slide that says, in a way, sort of, how does this work? So you get your map, your network map. We do our initial analysis, non-financial analysis. We get the insights out of non-financial analysis. We have a rule, and we deposit the companies in this fund. Bang, there you go. So we took companies, we tiered them through this whole system, and then we dropped them into these different boxes on the private equity and leveraged debt, and some of you might recognize some of these companies. So, but they essentially had the similar industry codes to the ones that came out of the network that Antti showed up. So it became now real. So we had to go from something abstract to a real investment fund that really invests in the Finnish economy, with real companies of the Finnish economy, using the real financials of the companies in the Finnish economy, and using the real non-financial risks of the Finnish companies that are participating in these Finnish economies. So, some more fun. We couldn't do that just with the two of us. So we had to do a lot of knowledge transfer, bring in people. Right? So we have US folks, we have UK folks, we have Finnish folks. So we did knowledge transfer in this project as was required. I said, you can't just come do this project in Finland and then, take it all back and whatnot. We want to impart that knowledge over here. So, a lot of fun work, a lot of fun training workshops, a lot of companies that needed to get churned through using this Keystone Compact and some of the financials. All right. So now we come to, so we had done this for the 3 funds. But what we had not figured out yet is, okay, all these companies now sit happily in their asset classes. And I haven't talked about the publics yet. I don't have a list for the publics here. But remember, what the pension funds wanted is, if you create a fund like this, it has to perform similar to an alternative asset, which is higher returns, but at the risk of bonds, or maybe a little bit more than bonds, which is, again, something that I thought to be impossible, because risk and return are correlated in a perfect market. So we invited and wrote a sub-proposal out of this to the Michigan Ross School of Business. And they have a program called the Multidisciplinary Actions Program. It's basically the MBAs have had 5 years of experience, these particular MBAs in the financial markets. We could specify a finance team with background on equity analysis, on all the different tools that the financial companies, financial management companies use to actually look at risk and return of individual assets as well as funds. And so this is the result for example, the Smart Mobility Fund. And they pegged it relative to everything else that's out there in the market. So this is return per year, right? And this is the annual standard deviation, which we got through value at risk, which is a measure of volatility. Yeah. So here is that multi-asset fund actually with the companies, the SMEs, the startups, the stocks, Finnish stocks and global stocks, and the bonds, the climate bonds, combined in one specific combination of asset allocation. So this way, more risk. This way, more return. Yeah? Okay. So here's our friend. Here's the MARF. Here's the multi-asset fund that combines, I forgot, Antti, how many companies are in there? Yeah, probably a little bit less than, maybe about 70 or 80 or so. I think we started down. But 70 or 80 companies sit in here. Yeah? But yeah, of course, didn't count all the stocks. So, lowest risk, of course, is cash. Yeah? Then you go to fixed income, EU investment grade fixed income. Fixed income is also low risk, also tend to be lower returns. And then you go all the way to the stocks. You go to listed private equity. You go to global real estate markets. A lot more volatile, right? But also higher returns. So the MARF, essentially, I mean, you could almost peg its return to listed private equity, right? Or finished stocks, but at the risk that is barely higher than fixed income. Let me say, is this real? Or is that just somebody who forgot to put in a comma somewhere? Right? So, this is another way of looking at it. So these are, I guess, if I would be a pension fund investor and I would look at what are all my options that I can put my money in, right? So you look at all the range going from cash all the way to private equity, the highest risk. So here's our MARF. So our MARF sits much closer to cash than to the other side. And the reason for that is what we call diversification benefits. Remember what Antti showed you. He showed you that map. Clean tech is not a technology and individual company. A clean tech industry, or a specific thematic clean tech industry, is very cross-industrial. It has energy companies, it has heavy machining companies, it has data companies, it has telcos, it has software companies in it. The way we mapped it on the real economy. There is no software company will ever say, we're a clean tech company. It's only the ones that generate the electricity or clean energy. They will say, we are a clean tech company. So most of our companies are actually not clean tech companies per se, but they're very essential to build out a clean tech ecosystem. And because they come out of different industries, these different industries don't all behave the same in the market. I mean, we were looking at some funds that are out there in the market. 80% of the companies in there are all energy companies, alternative energy companies. 20% are other companies. Guess what happened when Saudi Arabia decided to keep their spigot of oil open, right? And the oil price completely collapsed. What happened to all these energy? 80% of that fund were all alternative energy companies. Domino effect, right? Tuk, all down. The fund didn't do anything. So we're very diversified, and it's because of the diversification benefits that we actually created that kind of fund. So later on we said, is this the max we can get out of that fund? Is that the maximum we can get out of that fund? 6%, roughly 6%. Well, that was based on a specific allocation. Oh, it's not on here. Where we said 40% in climate bonds and 35% in debt and 15% in private equity and 10% in a thematic stock. We say, but is that the best? No, I mean, that's just something I pre-specified. It's a spec, right? So what is the best we could do? So the best we could do, so what he decided to do using simulation tool of 10 years of data, so essentially they were given the entire Ascastieto's database of the entire economy, everything, right? And just totally went to town on that. All the data analysts and the financial guys. And they said, you know, if we vary, you know, say debt from 10 to 40% instead of specifying at 35%, if we vary private equity from 10 to 20%, if we vary the stocks from, you know, some variation, we're able to achieve at the minimum volatility portfolio. So that would be the one that has the lowest risk. The lowest risk portfolio optimized, I guess, based within those margins, I guess, that they were given. This is not gross. This is not net back to investors, right? This is gross return, 7.7%. Here's a maximum Sharpe ratio portfolio. What does that mean? This is the best combination of the highest returns with the lowest risk. This is just the lowest risk. This is the highest possible returns with the lowest possible risk. So if you do an optimization for both parameters. So now we're at 10.5%. But you can crank up a fund like that that's 14%. Now, of course, this becomes a lot more risky because what you're seeing here is more allocation to private equity, which is more risky, more to debt, much less to bonds. 40% bonds, 20% bonds. Bonds are safe. This is not safe. So now we're working with Agnieszka, who is here from Haaga-Helia University, on what would be the impact of public-private leverage. So public investment fund, a public guarantee, 20%, 50% on debt, to still get these similar returns to that, but dial down the risk similar to where this one is. So basically now you start playing with optimization scenarios, right? So, but again, they're the actual real companies out of the Finnish economy. So, this is what these guys do in the office. I guess when they're not doing a MARF assessment, they're doing fitness performance assessment. Right? We have to have some fun too, because, staring at a computer for that long, you got to do something. Office planking is one of the things I learned at ETLA, and I'm taking that with me to Michigan. Everybody, drop it 3 minutes. Right? So it's a great, great bonding, team bonding experience. So, multi-asset funds, designed in Finland, exported abroad. Very important for this entire audience to learn. I told you earlier, in many different areas, Finland is first. Finland is still ahead of the curve. That's where you guys are. But catching up quickly and taking off. Right? Switzerland, Taiwan. I'm leaving for Taiwan next weekend. They have a new incoming government. Just came in on the 21st of May. Meeting with the finance minister, meeting with their the Green Trade Office, a bunch of other folks to actually design a couple of MARFs from the very beginning to the very end to help them transform their economy. They want to get out of semiconductors. Semiconductors are not doing too well for them anymore. It's all outsourced to China. So in the US, we're starting with that. A lot of that will depend on, I guess, what's, gonna happen. And I'm hoping that it will not be Trump. I'll just show my colors here for more reasons than one. But if Hillary were to win, of course, Chris already talked about Little Rock, Arkansas. I've been working for the last 4 years with Jennifer Granholm. Jennifer Granholm is the former governor of the state of Michigan, a Democrat. She moved after that to Berkeley, became a policy advisor, policy analyst, and is over there. She has been working on developing roadmaps to convert the U.S.'s 10 largest manufacturing states, Michigan, Pennsylvania, New York, Ohio, all these Midwestern states, to convert them to green economies. If Hillary gets elected, Jennifer Granholm will be the industry investment guru for the Clinton administration. And we got MARFs going in the United States as well. But you're still there. We'll just watch them. So, Finland's MARF opportunity. I wanted to bring this up. There's been a lot of discussions, and thanks to Nina for bringing this up yesterday. Mission innovation. Right, post-Paris Accords, I guess about accelerating the clean energy revolution was approved 2 days ago by Finland and the European Commission. Is that correct? Okay, I'm looking at Yuri also. Just want to make sure I don't say, oh, coming soon. So opportunities here, because part of this is going to be about investing at scale. The Breakthrough Energy Coalition, Chris brought that one up, which is a lot of private investors. Essentially, the multi-asset fund is an alternative asset. Part of it is private equity venture capital. And what the fund would do, what the MARF would do, is actually participate as a co-investor in other private equity and venture capital funds. This is a technicality, but it's an important technicality for the risk and return calculations. So, but basically, over 2.5 years, Antti and I had initially a discussion where we were given a list of 2,000 Finnish clean tech, self-identified clean tech companies. Yeah. And we needed to figure out a means or a way to structure, organize, find efficiencies in sourcing, find efficiencies in allocation, find efficiencies in investment management of those types of groups of companies. And this was my last slide. So we ended up from this to this. All right? So a lot of validation since a discussion over a beer in a pub, Irish pub in Dublin. That's it. Thank you.